gentlemen, it's now up to David Rosenbloom and myself to describe what's going on in the US and in the EU in just 1 hour of time, which is an enormous challenge given what's happening all around the globe, in Europe and in the US. But we'll do our best, and luckily we already had a presentation from the IBFD this morning which covered some of the elements. Please, David, have a seat. What we'll do in the next session, I will kick off with a tour d'horizon about what's going on in Europe and describe the EU tax landscape. I will touch upon some elements in a bit more detail. Other ones I will skip through because the IBFD has already touched upon that in his presentation, and I want to avoid overlap. And moreover, I would like to have most of the time to hear what's going on in the US. My challenge was quite big as things are going on quite rapidly in the European Union, but I think the challenge for David was even bigger, as you know that in the US things change by the day and even by the hour, so I'm very curious what we'll hear this morning. Let me start first by setting the scene about what's happening in Europe. Very quickly, started of course with the BEPS reports, today almost 2 years ago issued in 2015. The anti-tax avoidance directive, basically there are 2 directives. One was issued 12 July 2016 and the other one in May 2017. The first one had a lot of action items and number 2 was specifically addressing hybrid mismatches. And now the biggest challenge in Europe is for the 27 member states to implement that in their domestic tax law, which is a huge challenge. For example, in the Netherlands, we can expect the first draft legislation by Q1 2018, and then we really see what it means for our country. And the same is happening for other European countries. There's also another significant development going on. Tax rulings and advanced pricing agreements are now exchanged between member states. There's a European directive issued by the end of 2015, and the same applies to CBC reports. So what you see on the other hand, there's a focus on anti-abuse, but also on the same time enormous developments about creating more transparency between tax authorities of member states that now have access to very relevant information and agreements between taxpayers and the respective member states. On top of that, what you also see is that the European Commission has grasped the momentum last year and also relaunched their 2011 proposal on the common corporate tax base, which is a really ambitious proposal. It's about harmonizing and coordinating the tax systems in Europe. It remains to be seen if that will ever go through, but a fact is that it was issued in 2011, and now again they use the political momentum because they smelt the support for this, and they reissued this last year. And last, number 7, there's a huge development around this state aid approach of the European Commission in Europe, especially affecting huge multinationals, many US multinationals at the same time as well. What you can see is that there's a lot going on, and there's much more, of course, than this. But if you look at these developments, that they all fit in one of the key 3 BEPS items, that is more transparency between tax systems, a more focus on real substance, what we also saw in the panel before the break, and a focus on coherence between tax systems. What I would like to do is, we've been speaking about the anti-tax avoidance directive quite a bit, but I would like to zoom in on some elements because I think that's relevant to illustrate what's really going on and create some understanding. Before I do that, what strikes me is that in Europe everyone is speaking about BEPS, and with the anti-tax avoidance directive, member states are now forced to implement that in their domestic tax law. That is a development that cannot be underestimated. And mind you, in Europe we have only 3 tax directives. two dated back from 1990, 27 years ago, one from the beginning of 2000, and now we have a third one really impacting the tax base of member states. So this is a real significant development. What strikes me is that if you speak about BEPS in the US, it seems that the importance given to this or the relevance is perceived to be not as significant as in the Eurozone. I don't know whether that's true, David, or that's something you can comment on or share your view on.
Yeah, yes. Can you hear me? Well, I don't have a mic. BEPS has been largely ignored for the past several years in the United States. The Treasury did its best to stay involved, but the Congress paid almost no attention. The new U.S. model treaty, which came out in February of 2016, has some definitely BEPS-inspired elements. And now the new tax bills, which I will eventually get to, have got some items in them which are certainly consistent with BEPS. You won't find BEPS talked about. BEPS is basically a four-letter word in the United States. But you will, thank you. BEPS is basically a four-letter word in the United States. You won't find Congress talking about BEPS, but there's the fingerprints of BEPS are evident in the tax bill. And when I get to talking a little bit about the substance, you'll see what I mean.
Okay, thank you, David. I would like to, let's go. If you look at the anti-tax avoidance directive that is now out there in Europe and that member states have to implement, you see that it has these 5 action items relating to deductibility of interest, exit taxation rules, CFC rules, a very interesting a general anti-abuse rule, the GAR, and hybrid mismatch rules that were introduced or at least amended by ATAD 2. That needs now to be implemented by 2019, so the next year will be very important to see what's happening in each individual member state, what will be the draft legislation. And I would like to highlight some of these items. Till now we've been talking about this on a very high level, but I want to lift out a few of them to illustrate what it exactly means. For example, the interest deduction limitation rule. It was derived from BEPS Action 4, and now in ATAD Article 4, you see a new rule that limits the interest deductibility based on a fixed ratio of the earnings of 30%. It's an earnings stripping rule. This is completely new for a lot of member states. They don't have such a rule, so they will now have to think about how does it fit in their domestic corporate tax system, how does it relate to other interest deductibility rules, and of course this is very relevant for structuring, if you speak about financing companies, financing structures, and how do you anticipate on this. I won't discuss the details, but I found very interesting is that, of course, we as member firms have to deal with this. And what does it mean for our own member state, our own tax practice? And I think in that respect, it's good to know that some member states already have these kind of rules. In Germany, there is an earnings stripping rule since 2008. Initially, it had a threshold of 1 million, which was increased to 3 million in the financial crisis, and it applies to tax groups. I think here, and of course I'm not a German tax expert, but what I found really interesting is that in Germany, our German colleagues, of course, have experience with this. They already know how to deal with such a rule. For example, some very simple planning ideas is play with deconsolidation, that each separate entity can benefit from this 3 million threshold. Certain funding structures fall outside the scope of these rules. And with the group ratio, you can influence that by having several shareholders in funding the top holdco with debt and then creating a better group ratio, which also allows for the opco to have more interest deductibility. What I would like to, why I mention this is that this emphasis the need also in Europe, in the Eurozone, to have tax technical meetings and exchange these kind of best practices, but it's clear that every member state, every member firm in other countries that don't have such a rule can clearly learn from other countries that have such a rule, for example, in Germany in this case. So I think the next year will be very important, because then we will all be confronted with new legislation, and then certainly there is a momentum to share best practices in this respect. Another thing is the CFC concept. Same thing, not all countries in Europe have this. It was in BEPS Action 3 and now in Article 7 and 8 of the ATED. Of course, there's a lot of technical details behind this, but the main point is that under these CFC rules, what they try to avoid is that you allocate passive income to low-taxed subsidiaries abroad, and under CFC, this income may become taxable in the home state territory. Also, this is an example that not all member states have, and the member states that don't have such a rule will learn how to apply it and what it means in the tax practice. And I think also there it makes sense to reach out next year and see what we can do with that, and where we can learn from each other. I want to spend some words on the GAR. In technical presentations, you see that often this is either skipped or only touched upon very briefly, but I think this is a very, very relevant rule, and will have potentially a major impact on our business. What you see in this rule, there is a main purpose test in this rule, and it aims to ignore artificial structures that don't have real substance. Here is referred that an arrangement may be regarded as non-genuine to the extent they are not put in place for valid commercial reasons, which reflect economic reality. There are already quite a number of cases pending before the European Court of Justice, more and more cases about what is abuse and what is normal use of freedoms in the internal market. Here you have one GAR, which will apply to all member states, and it aims at a consistent approach of anti-abuse. But there's a lot of uncertainty around it. For example, you see here that it refers to valid commercial reasons. To date, in the case of European Court of Justice, the Court of Justice made a sort of distinction between you have either tax rules or a tax motive or a commercial motive. Here you see that if you have commercial reasons, apparently you can also have valid and invalid commercial reasons. So real question out there is, what does it exactly mean, and where is the threshold between a completely artificial tax-driven structure and a structure that has sufficient commercial reasons behind it? And especially if we speak about what we did in the previous session about holding and financing structures, this of course is extremely relevant. Another struggle is that, of course, nowadays, when there is a legal structuring that is presented to the tax department, to us as a tax advisor, and almost always we provided input on that legal documentation. So in that respect, tax is nowadays always at least part of the purpose of arrangements. And the question is, where is the balance between becoming part of the main purpose and where not? So a lot of uncertainty, but certainly relevant for us. I also like to mention that in the preamble of the ATAD, there's a very important statement which is completely in line with the case law of the European Court of Justice, that taxpayers in the European Union have a fundamental right to structure their business in the tax optimal way. And you don't have to pay the most taxes you can. You certainly have a right to structure in a tax optimal way. And yeah, that's a fundamental right. And the question is, where's the balance between this right to structure things in a tax optimal way, and when does it become a main purpose behind the structuring? Really interesting questions, but eventually really relevant for us if we set up and structure companies. Last thing I want to mention about this is that in the case law to date, we knew at least one thing, and that is that the European Court of Justice said there is no artificial structure if there is substance present in a structure. Nobody knows, like the IPFD said, what exactly substance means, but we knew it cancels out abuse. If this will change, if under the ATET they will say, okay, you have commercial reasons, but they are not valid enough. So in other words, you have a certain level of substance, but it is so much tax-driven that it cancels out the substance. Yeah, then we have a totally different game. And also for us, questions like substance tax planning, will that still be allowed, or will that be part of sort of illegal, tainted tax planning? All kind of questions. It's a very general rule, but I think it will be very impactful for our structuring. So we have to carefully monitor this. I go quickly through this in sake of time. Another rule in the anti-tax avoidance directive was the anti-mismatch rule. This structure was on the slide this morning in the IBFD presentation. I don't agree that the structure is completely killed. Actually, behind the scenes in the Netherlands, within the tax authorities, we know that they are looking for ways, if there are alternatives, to make it still possible. I say that very carefully because, of course, this is the type of structures that were under the loop when the in the BEPS project they looked at this. But certainly, it's not over yet, and we'll definitely have to see where it goes. I think this is still considered a very, very aggressive tax structure, but I really am not sure if after 2020 they will be completely abolished or we see some alternatives in this respect. We'll really have to see. Last very important development in the Eurozone, especially in relation with the US, is the European Commission against illegal state aid by our lovely lady from Denmark, Margrethe Vestager, or Paul mentioned that I cannot pronounce his name at all, but she is actively going after big multinationals, and very often US multinationals, to see if they have made agreements with tax authorities in member states that contain selective advantages whereby these multinationals have an advantage over other multinationals, and in other words, that distorts competition in the Eurozone, for which she is responsible. And if we believe her, as she said in respect of Apple, that they had a 0.005% effective tax rates on their European profits. On the one hand, you could say the tax advisor did really a good job, but I think nowadays they look at this a bit different because they have a claim above their head of 13 million US. I know, Dave, we have little time, but I know in the US this has been big in the news. Actually, I have a slide on that. And they have said, Margaret, our Danish commissioner, is going far beyond her role, and it is perceived as a supranational tax authority. So actually this sounds like she might have a different agenda, and not only looking at state aid and competition law. Can you say something about how this is perceived in the US?
Well, how it was originally attacked by the Treasury as being wrong, that the Commission's analysis was wrong. I actually have gotten very close to the Apple facts, not because I represent anybody involved in it, but because I was asked to speak at a conference like this. And I actually, it's pretty hard to understand what actually happened at Apple. Neither the Commission nor Apple has been very forthcoming about describing how they made all this money. But my own hunch is that an awful lot of the business deals that produced the money, which was largely the sales of the iPhone, were generaled out of Cupertino, California. And my own, I've said this publicly, nobody pays any attention to it, but I have said it publicly repeatedly, that the real question is, where is the IRS in all of this? I think Apple was probably engaged in a trade or business in the United States, and there's no treaty protection in this case because the Irish entity at Apple is not a resident of Ireland. That's the whole point. So my general slides on this are entitled "A Plague on All Their Houses," because I think pretty much everything that everybody has said about the case is wrong. The rightist party in all of it is the government of Ireland. I can't see what they did that's so terribly wrong, except sit there while Apple was earning all this money. But I don't think their ruling was wrong. I think the Commission is really kind of nuts. I think the U.S. Treasury is wrong to get excited. And as I say, the real question is, what about the U.S. tax system, which, as far as I can tell, the IRS is pretty much ignored. That's my take on it.
Thank you. Last item I would like to mention is Brexit. Only very, very brief. Because you see this tax rate competition going on. We saw it also on the slide of the IBFD. You see the UK advocating its system and saying, well, we'll have a tax rate of 17%. Of course, coming from the Netherlands as the close neighbor of the UK. What I can mention is that last month we had a new government, and very surprisingly, what they did is announced a change to their corporate tax system, and for the first bracket, it will go down to 16%. And when I saw this, I thought, well, that's absolutely no coincidence. 17 in the UK, and then 16 here. So you see a game going on there, and I'm pretty sure it will be followed by other member states as well. So I'm really curious where this will go to. And that links in with what's happening in the US as well. We know for the last 10 years that corporate income tax rates in all OECD countries besides the US, the corporate income tax rate dropped significantly, causing all kinds of deferral structures between the US and mainland Europe. And now we see this proposal of 20% in the US, which in my view could certainly affect the tax practice very heavily, because all these deferral structures are eventually driven by the high corporate income tax rates, successful US multinationals making a lot of profits, and try to defer that overseas. So I'm really curious what it will do with that. But I think with that, David, I'll stop here, and I'd like to hand over to you to hear what's going on in the US.
I'll trade you that mic for this one.
Yeah, sure. This is the clicker.
Okay, well, thanks to Baker Tilly for inviting me to do this. Let's see, I have to figure out how to do this. Okay, I prepared my own slides, which are inserted in the deck, and I capitalized today, and it was really appropriate because today is a big day. The bill on the Senate side may come up to the full Senate today. In fact, it's supposed to, but a lot is going on behind closed doors. Let me tell you what I'm going to do. My original slides was designed to talk about politics and process, because I know a lot of you, for some of you I know that's old hat, you're in the United States, you can follow this. Outside the United States, it's virtually impossible. I mean, we tax professionals are following it on basically an hourly by hourly basis inside the United States, and it's very hard to get information. So my basic presentation is about the bills and where we are and the process and what's going on. And that, what I'm about to tell you, is relevant for about the next 4 days. Then I'm going to talk about the international. I'm going to separately at the end talk a little bit about the international provisions. But before, it's confusing. Everything about the situation is confusing. Before I start on the politics process, I want to make one comment about where, if these bills go forward, where I think the U.S. is headed, because it is relevant to the structures that Gijs was talking about and the developments in Europe. If the United States adopts anything that's on the table now, a lot of what I'm going to talk about goes to that if, but if they do, we are going to have a fairly simple world. It's going to be complicated for tax professionals, but here's the world. We're going to have a 20% corporate tax in the United States, and we're going to have a maximum 10% tax on foreign earnings by foreign corporations. End of story. And it's going to be a current tax. Deferral's not going to be involved. There's no deferral, really. And there's a lot of zigs and zags to get there, but the U.S. is simply not going to tax foreign earnings at more than 10%. And so I think some of the structures that were talked about are going to become irrelevant, not because the U.S. is going to attack them, but because the U.S. is going to become indifferent to them. And what we're basically saying is, and this is also relevant to the state aid cases, what we're basically going to say to the world is, if you want to tax this,
go for it. And we're going to lose leverage abroad in discussing these cases. I'll get back to all of that and answer any questions, but I think the main dynamic that I see is the U.S. withdrawing from imposing its tax system on foreign earnings and leaving it to the rest of the world to do what it will. And frankly, I think leaving a lot of U.S. companies without backstop by the U.S. government, because the U.S. government is not going to have much of a stake in the game. Okay, so let me come back to what I originally. I'll come back to the international provisions. Here's the way I see the situation as of today, bearing in mind that I did these slides 3 days ago and they're already slightly out of date. All right, there are two bills. A lot of this is going to be old hat to Americans, but for non-Americans, we have two separate bills that have been developed. One in the Senate and the other in the House of Representatives. We have a bicameral legislature, and they're quite independent of one another. And the bills that have been developed are very broadly, and I say this is the picture from 70,000 feet, very broadly similar, but there are significant differences among them, and that's where some of the trouble lies. Both bills call for a reduction of corporate taxation. Now, I put in, when I drafted this, that parenthetical, especially on U.S. income, and I better explain that because there are some people who would jump out of their seats and say that's wrong, but I still think it's right. And it's financed by an assortment of very modest revenue raisers and substantial new debt. So what we're basically doing is borrowing, adding to the balance sheet, borrowing a lot of money in order to give a huge corporate rate cut. That's really what's going on. Now, why do I say especially U.S. income? The corporate rate will go from 35% where it is now down to 20%, assuming everything this passes. I've already said, foreign income will go down to 10. And everything about this bill depends on your perspective. So if you assume, as I've seen articles in the press that say this, that we tax worldwide income at 35%, we're going from 35 to down to 10%, which is an even bigger jump than from 35 to 20. And moreover, people will say, and they do say very loudly, this is going to create a huge incentive to send U.S. investment abroad because you get a lower rate abroad than you get inside the United States. All of that everything about this has got its truthful elements to it. And there's some truth in all that. But the fact of the matter is that the 35% that we now impose on CFCs, controlled foreign corporations, is illusory because of deferral. U.S. companies can maintain their earnings in foreign corporate solution indefinitely. And so, sure, if they ever bring it back, we would tax it at 35%. But while it's abroad, we're taxing it at 0. So it is a classic glass half full, glass half empty situation. From the standpoint of people who think we tax foreign earnings at 35%, and yes, we do in the fullness of time, this is a huge tax reduction. From the standpoint of people who are more practical and say, well, we're not imposing any tax on lots of these foreign earnings, it's an increase. And that increase to 10% is going to hit some U.S. multinationals. There are going to be companies that are now in their foreign CFCs paying substantially less than 10%. And I'm a little surprised that you don't hear more screams of agony, particularly from the IT people and the pharma people, who I think are lower than that on their effective rates on foreign income. Mind you, I haven't studied any of this. This is all sort of my impression. So the question whether there's a tax increase or a tax decrease on foreign income, you could argue about that depending on your perspective. But the focus of the entire bill is the United States, is the corporate rate in the United States. Let's see. So I say, disregarding the rhetoric, and this is I should have basically said two things. I should have said this initially. Everything's moving very fast. So by the close of business today, there could be a lot more to say. That's one thing. It's a very fast-moving target. And also, some of what I have to say is my own take on what's going on. Obviously, everybody's got their own take on this bill. So inevitably, my own views on where we're going and what it means is personal. My own view as of today, notwithstanding all of the rhetoric, is that the bills are probably not as good as the Republicans in Congress are asserting, and they're probably not as bad as the critics are asserting either. It's probably both sides have been a little bit over the top in their positioning. The big problem with this bill, from my perspective, is not the increased inequality. It's not favoring corporations over individuals, which I think is a false equivalence anyway. I mean, I could expand on that, but I think that it's ridiculous to, individual taxation, corporate taxation are two separate subjects. I can see the case for reducing the tax on corporations. I can frankly see the case for increasing the tax on individuals. That's bad politics, but from a tax policy standpoint, I understand it. But the big problem, the really big problem, the elephant in the room here, is that we're going to really inflate the deficit. And that could create all sorts of distortions down the road. And we'll come back to that several times in my comments. All right, so here's the bills. The Senate bill, and the Senate bill would, and these are not in any particular order, it would repeal the tax that is associated with the individual mandate. For those of you outside the United States, on U.S. tax returns for the past 3-4 years, there's a box which you check, which effectively says, do you have adequate health insurance? And if you don't have adequate health insurance, you pay a penalty, which the Supreme Court of the United States has called a tax. That tax is, under the Senate bill, to be eliminated. And just so that you understand the arcane intricacies of this, if that tax is eliminated, the assumption is that a number of people will cease to take out health insurance, and those will predominantly be young and healthy people. If they drop off the insurance rolls, the idea is that the insurance premiums will rise for everyone else. And they will rise to a level where relatively poor people will not be able to purchase insurance at all. So there will be, if you read the popular press, you hear about 13 million people losing health insurance. The idea is that a lot of people would drop off the rolls because they won't be able to pay for the increased premiums that'll come from these healthy people ceasing to take out insurance. If the poor stop buying health insurance, apart from the fact you lose 13 million people from health insurance, that actually is a revenue raiser. That's why the Senate put it in there, because those people were buying insurance and receiving a subsidy under the Obamacare legislation. So if that subsidy doesn't have to be paid, that counts as a revenue increase. It's a savings to the government. That's $300 billion, and that's been very helpful on the Senate side for reasons that I'll explain in a moment. In any event, the Senate side proposes that. They also propose to completely repeal the deduction for state and local income taxes, which is a big deal in high-tax states, mostly Democratic states that mostly voted Democratic. New York, New Jersey, California, Illinois, and that's a big deal for the individuals. There's been some talk about eliminating it for businesses. That has not yet come into focus. That would be a gigantic number for companies operating because they pay a lot of state and local taxes. In any event, the Senate side is complete elimination of state and local. The Senate addresses much more comprehensively the international issues, and when I get to summarizing the international, the menu of international changes, I'll operate on the Senate side. They plug a variety of holes in the statute. They override a couple of court decisions that were adverse to the tax authorities, and they particularly take aim at inverted companies, and I also ought to say at hybrid entities. There's a BEPS element there, and nobody mentions BEPS, but there are provisions in the international menu which are anti-hybridity, and otherwise available benefits are withheld on payments to or from hybrid entities. The reduction of corporate tax rate to 20% under the Senate bill is deferred until 2019. That's important. That's a one-year deferral. And there's immediate expensing of capital investments. Some people say that the inducement to make investments is actually better with a one-year deferral because that means that for the next year you've got 35% rate corporate tax and you've got immediate expensing of investments, so people might hurry out to make investments in those circumstances. That's got the ring of plausibility to me. There's lots of sunsets of benefits for individuals. there's a 10-year window on the budget picture, and there's a lot of the benefits that are provided in the bill for individuals that sunset after that. That is to say, the rates on individuals start going up, effective rates go up, and that's caused a lot of furor in the press. And also, there's the elimination of some of the revenue raisers if, this is a very odd provision, if U.S. collected revenues achieve certain levels. We've never seen anything like that before. So that's what you got in the Senate bill. That's some of the major pieces of it. The House bill has its own gimmicks, but it lacks a lot of the gimmicks on the Senate side. The Senate bill is filled with gimmicks and feints and what I call vanishing acts, things appear, then they disappear at a certain time. And the House has less of that. But I think that the Senate bill is where we ought to focus. I mean, each of these bills is complicated enough without considering both of them simultaneously because they're different. But I think in trying to understand where we are, at least as of today, it makes most sense to focus on the Senate bill. And the reason is this. As you'll see, I'll explain in a moment, it's going to be the hard job is going to be to get an agreement in the Senate because the Republican majority in the Senate is much less than the House. And if they can get an agreement in the Senate, I will be astonished if the House tries to muck around with that agreement and make changes and then put it back to the Senate. That would be asking for trouble. So if any agreement they get on the Senate is going to be fragile, it's going to be difficult to get, and I don't think the House is going to want to disturb it. So my guess is that if they do reach an agreement in the Senate, and that could come as early as today, the House is likely to just accept it. So let me explain well, no, I'm not at the process yet. Just hold that thought. That's why I think the Senate bill is, I'll get back to why in more details in a second. Let me just say both of the bills would bring in huge complications into U.S. tax law. The international, I haven't spent a lot of time on the domestic provisions. The international provisions are quite complicated. They also, inevitably, because this thing has been drafted in haste, there's going to be all sorts of technical amendments and errors and gaps and holes, and it's going to be a mess. It's going to give us all something to do for a few years, but it's going to be something of a mess. The basic aim seems to be to attract investment to the United States, whether it be new investment or investment that has previously gone out of the United States to bring it back. So the focus is it is really, to quote the president, an America First type approach to taxation. There's been a lot of talk about the estate tax. Neither bill immediately repeals the estate tax. The Senate raises the level for estate tax. It doubles it. So we now have, in the United States, as you may know, something like 5,000 taxable estates. Who knows how many we'd get. Somebody told me that 6 families in the United States are themselves responsible for about half the amount of the estate tax that we collect. I think that's probably right. So this business of small farmers and small businesses is just ridiculous. I mean, to anybody who knows what they're talking about. But the big thing is that it's going to add hugely to the deficit. That's a theme I'll keep coming back on that because that's also a big problem. All right, here's where we are. You can't go forward with a bill. You cannot make a law unless both houses of the Congress pass an identical bill. And normally what happens is that the 2 houses develop their own bills, and then they come together in a conference. They make changes. Each house accepts a little bit of the other house, and then they go back to the 2 houses, and the revised bill, as amended in conference, has to be passed again by both houses, and then, only then can it go to the Senate for signature. I think it's clear that anything that gets to the president's desk is going to be signed. So the whole problem is it going to get to the president's desk? In the Senate, there's only a margin of 2. There are 52 Republicans and 48 Democrats. And so if 3 Republicans oppose the bill is dead. And if it's dead in the Senate, it's dead. It's not going anywhere. It's just like what happened with the Affordable Care Act, Obamacare. Dead. 3 people voted against it. It's gone. It can always be brought back, but it's gone for the moment. 50-50, if there's a 50-50 tie, the tie is broken by the vice president. That's Mr. Pence. He's, of course, a Republican. So 2 opposition votes don't kill the bill. 3 will do it. 3 will do it. Now, where are we? You have about 7 or 8 individual senators who have expressed reservations about the following. One is eliminating that tax on the individual mandate. Particularly, this is Senator Collins, Susan Collins from Maine, who voted against the elimination of the Affordable Care Act, the Obamacare, before. She's concerned. She comes from a state where there's a substantial number of poor people taking advantage of what Obamacare has given, brought a lot of people onto the insurance rolls. She doesn't like the idea of eliminating the individual mandate. One could debate, I'm myself somewhat skeptical that eliminating the individual mandate is going to have this drastic effect that the nonpartisan budget office has said 13 million people. I'm not so sure 13 million people are going to drop off their rolls. But in any event, she has expressed problems with that. And she has said that she will only vote, and everything that these senators say, by the way, is subject to reversal on a dime. So you can't take anything and say it's done, you know. But she has said she won't vote for this unless the Senate also passes a compromise Obamacare agreement that was reached by Senator Alexander from Tennessee and Senator Murray. Alexander's Republican, Senator Murray, Democrat from Washington. In today's paper, the Congressional Budget Office said that that piece of legislation won't have any effect on the individual mandate. So I don't know what Senator Collins is going to say about that. Who knows? This is not a logical process. She's saying if you pass this Alexander Murray bill, then I'd be willing to pass the tax. She sort of said I'd be willing to pass the tax act. The Congressional Budget Office has now said the Alexander Murray bill is irrelevant to the loss of people from the insurance rules. I don't know what you'll make of that. The second thing is 2 senators, one from Wisconsin, Senator Johnson, one from Montana, Senator Daines. This is Republicans. Well, I'll come back to that in a second. They object to the treatment of pass-through businesses. What they're saying is that the reduction to 20% for corporations is too great by relationship to the benefits that are being given to businesses that operate in pass-through form, so that the tax falls not on the business but on the owners of the business. The Senate bill offers a 17.4% deduction, which translates at a 39% rate, 39.6% rate, roughly the right rate, and something just above 30%. So what Johnson is essentially saying is you're taxing pass-throughs at effectively 30%, you're taxing corporations at 20%. That argument has got all sorts of flaws in it. For one thing, corporate earnings are taxed at the individual level as well as the corporate level, and nobody takes that into account. But Johnson has said he's an absolute no unless they change this. Now, 2 things about that. One, Senator Johnson is pretty well known for staking a position and then abandoning it when it comes to the vote. So at least and I think most people, take his statement with a lot of grains of salt. We're not at all sure that he's really going to know. There's been talk about raising the deduction from 17.4% to 20%, which would be very expensive. It would cost a lot of revenue. I'll come back to that. That's a big concept here. I'm not sure whether he'd go along with that or not. I'm not sure. He might go along with it at 17.4. I think counting him as a no it's too early. Notwithstanding that he said, I'm a no unless that's changed. The bigger problem, I think, is C, the likely increase in the deficit. There are a couple of senators, all Republicans. This is a Republican show. The Democrats are all against this. All 48 of them are against this. So there are a couple of Republican senators, Senator Flake from Arizona, and, well, actually Senator Moran from Kansas, whom I haven't heard of from very much, but Flake is one, and Corker from Tennessee. have said that they won't, Corker has said he won't vote to increase the deficit by 1 penny. Not 1 penny will increase the deficit. Well, the whole bill is based on adding $1.5 trillion in additional cost. I mean, it's going to lose $1.5 trillion, and if it doesn't increase I don't know where that money's coming from if it doesn't increase the deficit. There's a lot of talk about how this is going to create economic growth, but out of a survey of 75 economists of all political persuasion, 74 of them said that was nonsense. So we'll see. That's a serious problem, that deficit problem. And it's exacerbated by the fact that the president, I think those of you in the United States know this, but perhaps outside don't, has gone out of his way to attack personally both Flake and Corker individually in pretty harsh terms. Neither of them is running for re-election. So in a sense, it's a free vote for them. So it's not at all clear where they're going. Corker also has a little bit of the Johnson characteristic of saying one thing and then voting another way. So none of these people can be taken for granted. I don't know. And the really wild card, there are a couple of other senators I haven't even mentioned, but the really wild card whom nobody seems to really pin down or talk to is McCain. McCain voted against the Affordable Care Act. My own take on this is McCain will vote for the tax bill unless he is the deciding vote. If McCain is the deciding vote, I'd be willing to bet he'll vote no. He hates Trump. Yes, sir. Did he? Half an hour ago? Yeah, but okay. Solidly in favor? I mean, they come out in favor, they slip.
The words were, I'm in support of it even though it's a flawed bill.
Okay. Well, there you go. See, everything is happening very, very quickly. I would have thought McCain would go negative if he was the tiebreaker. Because frankly, this bill is going to be criticized. I mean, it's very unpopular with the American public, and who haven't had the time to really assimilate it. And I think what will happen, I'm not sure how McCain sees it. McCain is very ill, as we know, and I don't know how he sees his future on that. Any event, let me go to say the problems. Addressing the problems that the senators have raised gives rise to, there are 3 problems. One is there are other concerns for other senators. I'll get back to that in a second, particularly with respect to Corker. Secondly, adding even more to the deficit. That's a problem for Corker and Flake and maybe Moran. And the Senate has got these very bizarre rules and very hard to understand rules relating to revenue loss. Let me focus on the first of these, the new concerns for other senators. For other senators. Corker says he has reached an agreement with the majority leader, McConnell, to have a provision, I don't know whether it's a provision or what it is, but that there would be an automatic trigger, that's the operative word, whereby if we didn't get this astronomical growth that people are estimating, tax benefits would disappear and there would be a rise in taxation. And that concept, although there's been no text or even any kind of indication of how that would be implemented, that concept has made a number of the senators come out of their chairs with negative views. They don't want a trigger. So I think a trigger would be greeted with hostility by lots of people in the Republican majority. So I don't know how you satisfy Corker without the trigger. On the other hand, he may be malleable. I mean, as they all are. The arcane rules are themselves interesting. As those of you in the United States probably know, but outside may not, this whole process is being done under something called reconciliation. And they're doing it under reconciliation in order to allow it to pass the Senate with only a majority, a bare majority, which is 50-50 given Pence breaking a tie. So that means that what the Republicans are trying to do, which is exactly the same as they tried to do in the Affordable Care Act, is to pass this with only Republican votes. The Democrats have essentially been frozen out of the process. Every once in a while somebody says, why don't the Democrats join us? But there's been no effort whatsoever to bring them involved. And it's clear the Democrats are not going to vote for this. So reconciliation means that they're reconciling the tax bill to the budget. So they passed a budget calling for an additional $1.5 trillion above and beyond prior spending, and this is the and they are. That's what they're trying to shoehorn into is $1.5 trillion in the. Now, what they've done in these bills is actually pass laws that lose more than $1.5 trillion, and they've got, as I say, various gimmicks and vanishing acts to try to bring it back within the $1.5 trillion. And one of the things they do, in the Senate in particularly, is they have a lot of individual benefits go away after the 10-year budget window. And that brings them down so that they've got a chance to bring it within $1.5 trillion. But at the same time, when they say, well, you're going to hurt the middle class with those individual cuts, they say, oh, no, those are going to be continued after the 10-year budget. Nobody's going to eliminate those. So they're saying that at the same time, we're going to eliminate the individual benefits after 10 years, and they're also saying nobody's going to eliminate those individual budgets, those individual benefits after 10 years. So that's reconciliation. Independent of that, you've got something called the Byrd Rule, which says that if you add to the deficit over and above 10 years, your tax laws are temporary. And that's what happened with the Bush tax cuts. You may recall, they sprang back into effect. So they're worried about the Byrd Rule. That was named after former Senator Byrd. And then there's something called pay-go, which is where they have to pay for anything that they lose. And frankly, it's very confusing. There's both a statutory pay-go rule and there's a senatorial pay-go rule. I think they can waive the senatorial pay-go rule. I'm not sure even how the statutory pay-go rule works. But all of these things limit what the Senate can do in terms of losing revenue. But here's where I was before. If a bill can clear the Senate, if they can get the Senate to vote it, my expectation, it says the expectation, but my expectation is that the House will just accept it. I just can't imagine the House going back in and arguing with the Senate. Now, what they may do, and what I think they're doing as we speak, is trying to take into account the absolute sticking points on the House side. And the one on the House side that's emerged as the biggest one is the deduction for state and local taxes. And that's because House members represent districts, whereas senators represent states. So there are Republican congressmen from high-tax districts, for example, in New York, in New Jersey. And those people say, we can't vote for a bill that completely eliminates state and local tax. So what they may do is try to negotiate those problems, those House problems, away, make adjustments in the Senate bill before it passes, and then so that they have a bill that the House, there's nobody who will choke on it at the House, send it to the House, and go forward without a conference. If they didn't do that, there could be problems in the House. And finally, my advice on this would be to read all of the press articles with skepticism, since almost nothing said about these bills seems to be totally accurate as far as I can see. Everything that's going on is regularly misdescribed by both politicians and journalists, some deliberately, some out of ignorance. Neither bill proposes a truly territorial system. This is not a territorial system. There's a 10% tax that will apply, could apply, and will apply to some foreign earnings. Neither bill is likely to benefit the middle class, or indeed individuals, not much. The benefit is really in the corporate level. Neither bill does anything to simplify the law. Both of them, both sets of bills retain a lot of provisions that seem unnecessary. A more deliberate attempt to do this kind of bill would have eliminated a lot of clutter in the Internal Revenue Code, but they've engrafted these bills on the existing code. And I don't think either bill is going to generate much economic growth. Most economic growth for large U.S. multinationals, at least, is not in the United States. It's abroad. And I don't think it's going to make a dent in the revenue loss. And finally, this part of my presentation, I can't resist saying that saying something, several times doesn't make it true. So I would urge you to, think carefully about anything that's said. Now, I'm going to just briefly run through what's happening in the international provisions. I have my own little, it's very hard to put them side by side and evaluate them. I'm sure some of you have probably done it more thoroughly than I have. But I see basically 10 sort of pressure points in the Senate bill. Sort of chunky, there's a lot of little stuff that this doesn't cover, but these are the areas where I think the changes are made. First of all, there's a repatriation of earnings, foreign earnings. Interestingly enough, on the Senate side, it only applies to post-86 earnings. I think my reading of the Senate bill is that pre-87 earnings can be brought back to the United States free of any tax at all. I think that's the way it works. Nobody has raised that. It's interesting. I'm not sure why they did it that way, but that's the way the Senate bill reads to me. Secondly, there's the dividends received deduction for current earnings. So that's what achieves what people call territoriality. You can earn income abroad and bring it back free of any tax. There are, on several of these provisions, including this one, there are carve-outs for two things that the legislation takes a dim view of. One is inverted companies, and the other is hybrid entities. They're exceptions. So my general points here are subject to those general exceptions. So repatriation of existing earnings, dividends received deduction for new earnings. Then the current taxes on foreign earnings are the global intangible low-taxed income, so-called GILTI income, G-I-L-T-I income, which is going to be taxed at essentially a 50% rate. It's fully taxed, but there's a 50% deduction. And then there's something called the foreign-derived intangible income, which is taxed at a 12.5% rate. That's as high as it gets on foreign income. And there's a lot of exceptions there. So it's and it's also done on a worldwide basis. One of the things we were talking about earlier is that all CFCs are lumped together. So I don't think from the standpoint of any given country you're going to be able to evaluate how the earnings are going to be taxed in the United States. The only way you're going to have a view on this is to look at the world. I mean, all the CFCs of a given U.S. multinational. Okay, so that's my third area, which is the tax on foreign earnings is GILTI, the GILTI rules, and the foreign-derived intangible income rules. Then there's a rule which is interesting, which provides for a transfer of intangible property abroad back to U.S. shareholders at basis. That's designed to lure intangibles that have been transferred abroad back to the United States without a tax hit. It's an interesting provision. I think it's got in the Senate, I think it has a 3-year sunset. It's not available forever. But the idea is we want you back in the United States. So that's the third point. Fourth, there's a bunch of tinkering with Subpart F. That's, in a way, the easiest to understand, because if you understand the Subpart F rules, you can see what they've done. Some of it's a little surprising. One thing that affects clients that I have, may affect clients you have, is that they're going to change the rule for how you determine who's a U.S. shareholder. It's now based on voting stock. It's now going to be based, in the future, it's going to be based on value. And a lot of people plan to have interests in CFCs but not be U.S. shareholders by not holding voting stock. That's gone. That's one of several little tweaks to Subpart F, which could be, in individual cases, could be very important. That's number 5. Number 6, there's a denial of the interest deduction. We heard about that earlier. There's another sort of BEPS idea. It's it's essentially a worldwide debt-to-equity ratio. I think there's a 110% of the worldwide debt-equity ratio. There's a denial of current interest. There's an indefinite carry-forward, but the interest deduction will be limited. That's 6. 7, there is an override, an interesting, sort of astonishing override of the recent Amazon decision, not specifically, not in Amazon's case, but they basically gave the Revenue Service, as far as I can tell, the major items that it asked for in Amazon and that were rejected by the tax court in terms of transfer pricing. So reasonable alternative analysis, aggregation of intangibles, treating going concern and goodwill as intangible property under 936 H3B. All of that stuff was inherent in the position that the IRS took in Amazon and lost in the tax court. And there's a statutory reversal, a statutory acceptance, I should say, of all of the IRS positions. So that's a strongly pro-government provision. It's interesting that it's there. But again, you can see the philosophy. They're willing to tolerate a tax on foreign income, but they do not want people transferring at least intangible property outside the United States. And that leads me to another observation, which is the people who say that this 10% rate abroad is going to lead U.S. companies to invest a lot abroad. I'm not so sure. I'm not so sure. It's not so easy. It's not going to be as easy as it has been to get out of the U.S. tax net, to put your investments abroad. Any event, that's there. Okay, then there is, well, I already mentioned hybrid transactions and related parties. I guess hybridity deserves its own separate category here. They've tinkered with the foreign tax credit. There's no more Section 902, no more deemed paid foreign tax credit. There's a deemed paid credit for what remains of Subpart F, and they've kept Subpart F, but it's the foreign tax credit for taxes paid by foreign multinationals goes away, which goes back to my initial point about leverage here. I mean, other countries are going to, we're basically saying to Margaret Vestager, go in, tax, I mean, we're not going to take a position. We don't care. There's no credit for it anyway in the United States. You multinationals, you're going to be on your own. I think there's going to be a lot of that. Oh, one other aspect of this. There's not a word in the Senate bill about treaties. And by my count, there's at least 3 or 4 of these provisions that raise serious treaty problems, including my final point, which is that there's a tax on certain base erosion payments by U.S. multinationals to related parties abroad. So you've got a 10% tax on certain kinds of base erosion payments to related parties abroad. So that's my list of 10 items in this bill. Now there's a couple that I haven't covered because they're sort of outliers. I won't go into all of those. It's not an easy read to get on top of it all. But I think if it goes forward, I don't see many of those things changing. And the people who are hit, the low tax foreign earnings people, the people who are paying tax on their foreign earnings at 1 or 2%, that would be you, Apple. As far as I can see, they're hit by this tax, but I don't think they're raising their hand to complain because I think their evaluation is that the reduction of 20% corporate tax on domestic profits is more than worth it. I guess that's there. I haven't talked to anybody. That's my guess. So thank you for your attention. That's where we are as far as I can see.
Any questions from the audience for David while he's here? Yes.
So, Professor, I think you mentioned that you think that the Senate bill will pretty much become what's going to be accepted by the House. And then from an inbound perspective, in the Senate bill, there's the legislative repeal, basically, of the tax court decision on Grecian.
Yes, I didn't mention that. You're quite right. I meant to. Yes, Grecian magnesite is repealed.
So you think that will...
That's dead. If the bill goes forward, that's dead. I have clients asking me about, what about this provision? Unless you've got a senator on the fence who's up there arguing for something, there are a few senators I didn't mention, by the way, but nobody's arguing about Grecian magnesite. If the bill goes forward, that's dead. Yeah.
Then, on a go-forward basis, as we look at inbound planning for, corporations versus pass-throughs, with the changes that are going on in the corporate structures, do you anticipate that basically in the future people will be looking more to do C corporation on the inbound side as opposed to?
My suspicion is that that could well be the case. You know, it really, notwithstanding that I speak with a certain degree of confidence about where I think this is going, this has yet to gel in my own mind. I mean, the more I look at this, there's a lot of nuggets there, and there's a lot of things, there's a lot of regulations to be written. So I think the broad direction of what's going to happen is yet to become clear. But notwithstanding that, I think your observation is probably right. I mean, I think people are going to say we're better off, we're better off coming in C corporations. I think that's where it's going. I mean, there's a lot of other things happening. There could well be, and they're hoping, a repatriation of assets from abroad back to the United States. That's certainly what they're hoping for. So I.
And then finally, do you expect it all to be wrapped up before the Alabama senatorial elections? We don't have to worry about
Well, they're certainly trying for that. I didn't mention that. The Alabama senatorial election is December 12, and that, if the Democrat wins there, the Republican majority drops down by one. That's why I think they're trying to pass it on the Senate this week. The dynamic in the Senate, this is an exciting time to be reading the U.S. papers. I mean, they're going to try to do the tax bill this week. So you might say, well, December 12 is the Alabama election. Why don't they wait till next week? And the answer is that next week they're facing the question of how to keep the government running. And that could occupy them 24/7 all of next week, because that drop-dead date is December 8. And I've never been certain. You know, the press says, you know, December 8 is the absolute date. There's always a little slippage to my way of thinking. But still, the way they're behaving, taxes this week. So what are we? We're today, we're Thursday. So 2 days, and they basically don't usually work on Saturdays. Next week, I think they're gonna have their hands full, just trying to keep the government running with a new spending bill. And there, they got to deal with the Democrats. And of course, predictably, the president has already said something which has told the Democrats they don't want to talk to him. So it's a happy situation here in the U.S. Any other questions? Yes.
Yeah,
oh, well, yeah.
Go ahead.
Yes.
Well, it's very interesting what is going on. I'm living in the south of border of the United States with Mexico. All my income is coming from Mexico, but I spend most of my time in the United States, so I pay taxes in the United States. That are sourced basically from Mexico. And that's my situation as individual paying taxes. It's going to be the situation of many of people that is living in that side of the border.
Right.
But my question, basically my question here is that for you is there anything in the legislation that is being proposed that is going to help or to promote the companies to create jobs, or is nothing on there and only this 10% in the willing for, or the hope that the companies are coming back to the United States, that capital is returning to the United States, by that fact is going to create jobs, or is anything else there that is proposing that?
Well, I mean, what the proponents of the legislation would say is, one, there are certain aspects of the bill which are designed to lure more investment from abroad in the United States, which would create jobs. Secondly, and more, probably more importantly in terms of their argument, they are saying that if we reduce the corporate rate from 35% to 20%, U.S. companies are going to take those additional profits and make more investments with them, and those investments will give rise to jobs. That's not the way economics works. The problem is that, as I said earlier, there are limited growth opportunities in the United States. We have an aging population. Heaven knows for other reasons, we're not admitting a lot of new immigrants to the United States. Very hard to come into the United States. The growth in terms of the economy of the United States is not going to be fueled just by having more money available. Plus, U.S. corporations, when asked what they're going to do with the money, is the additional profits, is they're going to buy back their stock, They're going to increase their dividends to their shareholders, and although they don't say it, they're going to increase their very modest executive compensation levels, right? So, I mean, that's basically what's going to happen. That's what happened last time. But the answer to your question from a proponent standpoint is the 20% is going to engender more investment, that's going to engender more jobs, and also we're trying to bring money, investment back from abroad. That's what they would say.
Let's take one more question from Theo and then go to the break.
David, do you see, if the bill's passed, do you see some pressure on some of the high tax states to reduce state income taxes, or maybe just limited to those Republican-held states? That
Well, you know, that's an interesting question. I mean, I've sort of thought, if I were advising California, which I'm not, I might be inclined to do the following. I might be inclined to reduce individual taxes, but I might also be inclined at the same time to raise corporate taxes. If I'm sitting in California and I look at the world and the U.S. goes to a 20% corporate rate, I scratch my head and I say, here I am in the 6th largest economy in the world, and they're reducing taxes, and they're putting pressure on my individual residents. I've got to do something for those individuals. But they're leaving a lot of corporate money on the table, and maybe I raise my corporate taxes. Nobody's asked my opinion on that, but that's the way I would look at it from the standpoint of New York, California. And I don't think too many companies are going to be able to say, oh, well, we just won't do business in California. That's not going to happen. So.
Okay. Thank you very much, David, for coming from NYU and to give this presentation. It's not been an easy task. It has been a moving target, as we all know, but I think you did a great job, and it was a very interesting story. Thank you very much for that.
Thank you.
David.
Thank you. Thank you. Oh, I wanted to say. Exactly. Oh, thank you. Yes, yeah. I know. Look, I direct the International Tax Program at New York University School of Law, and it happens that every other Friday, more or less, during the year, we have seminars, and they're open to the public. And tomorrow, we have a seminar from 1:15 to 2:45 that is going to be given by a young partner at PwC, and it's going to be on the international provisions of the new bills. So if any of you are interested, you're welcome to come. These things are open to the public. I would ask, if you are interested in coming, that you figure out a way to get notice to me in advance, probably through Gijs, because we have limited space. We have space for a number of people, but not this whole room. And in addition, we serve sandwiches, so if we're going to have a lot of people, I want to get enough sandwiches.
Thank you very much, David. And we have committee meetings tomorrow, but for those of you who don't have committee meetings and don't want to go shopping, more than welcome.
Yeah, you're
to
more
join
than welcome.
David.
It's at New York University School of Law, which is at 4th Street. It's at Vanderbilt Hall and Washington Square South. The address is 40 Washington Square South. It's essentially 29 blocks south of here. You can walk it pretty easily.
Okay. Thank you very much. I think that's it for this session. And back at 2 after lunch for the afternoon sessions. Thank you very much.